But the question was, what is the Fed going to do? They have told us that they are going to hike 3 times this year in 2018. They've told us they're going to hike 3 times in 2019. So that would equal a collective unit of 6 hikes. And it seems to be the medicine of the day is 25 basis points. Markets can stomach that. It's in small increments. It gradually inches up the Fed funds rate or the borrowing rates for a lot of the marketplace. It is Western Assets investment view that with the Federal Reserve will not reach those 6 hikes. It is our investment view that the economic data might come in a little bit lighter than expected. It is our investment view that inflation is not going to suddenly pick up and accelerate dramatically. And without a pickup in growth and without a pickup in inflation, it's really hard to argue for rates to move up dramatically from these levels. And so our line in the sand positioning for the television cameras is that if the Fed did 1 hike in March, the market expects them to hike in 2 weeks, another 25 basis points higher, that's 2. We could get 1 more in the second half of this year, and then our investment call right now is that maybe 1 next year. And so that's a little bit different than some of our competitors in the marketplace. That's a little bit different than what the Federal Reserve is telling us out loud. So we'll have to see how this story plays out. But less than 6 hikes between now and the end of 2019 is Western Assets' current view.
So I'll pick up, Chris, I know you weren't on the agenda for this question, but I think you guys are probably, it's near and dear to you guys on rates. And what's JPMorgan's thoughts on rates, and what kind of areas of the market are they seeing maybe have a bigger impact as interest rates go up? I would say though, for the first time in a long time, savers will start to get slightly rewarded as rates go up, which is good. But maybe if you could give us JPMorgan's thoughts on that.
Yep, I think you hit on a good point, and that is you finally start seeing some of the as the Fed fund only controls 1 rate. It's called the Fed funds rate. It's a very short-term rate. They have been manipulating a little bit over the last few years on the 10-year, right? So they've been issuing a lot of longer-term debt as well and buying it up too. But for those that are savers, right, and are building that savings, that nest egg there on the savings account, you are going to be rewarded as interest rates do move up. It's been a long time since we've seen those where you actually can earn some money, right, on some of your cash-like investments. We think that rates definitely are going to be going up. We think that there's a global synchronized growth story that's taking place. A few years ago, it was just a U.S.-centric story, that the U.S. was moving out of the recession and just plugging along, albeit at a slower pace than what other economic expansions were. But now we see the rest of the world catching up, playing catch up. So that's Europe, and a lot of emerging market countries. So when you start seeing some of the other economic data points outside the U.S., you start painting a picture, right, to where the rest of the world now is starting to kind of this locomotive gaining traction and moving forward. So with that, we just see the United States is kind of leading the charge in regards to raising rates. The European, right, ECB, right, the European Central Bank, next year may start to raise rates in 2019. That's usually a good sign that economic environment is moving in the right direction. So we do think that for this year, they do definitely have 3 rate hikes this year, just as they say. And next year, the Fed's saying 3, we think you actually get 4 rate hikes next year. So now you have the Fed funds probably closer to 2.753, and the 10-year potentially going between 3.5 and 4.